Yo guys, what's going on? Welcome back to Fulfillment Key. Today I'm going to be talking about dividends like we always do on this channel. And today I'm going to be going over the portfolio again. The last time I went over it, it was about like 2 months ago. And then today we're at a value of 138,000, down 6 to 8,000 from the money we've put in. So technically we're at a loss, but I just wanted to go over some of the positions, and I kind of axed a lot of positions off of this portfolio that didn't meet the requirements that I wanted, and also because I was kind of over diversified in a lot of different stocks. So the first thing I want to add about this portfolio, and before I hop in the video, make sure to like and comment and subscribe, all of that. You guys already know. But the first thing I added to this fund was just for dividend kind of assurance was Vanguard bond fund. And the reason I did this was because I just wanted some kind of secure high yield that was kind of untouchable, because a lot of companies started cutting their dividends. And although I wasn't that much of a victim of it, there were still some companies that I was holding on to that cut their dividends. So I realized that when it comes to like a high yield bond fund, there's a lot less risk. So I bought into that with about like 4.3K, as you guys can see right here. And a lot of these are kind of at a loss right now. If you want to look at the ones that are high gains, TD has this cool tool that shows you, if it let me click here. And then, yeah, but a lot of stuff that was high kind of just dropped super low. Yeah, so back to the normal chart that we showed last video. So as you guys can see here, this is the estimated annual income based off of the portfolio value, which is 138,000 something. So this is the average yield on cost. So it's 5.06, which is not the best in the world, but it's a lot safer than some other portfolios I've seen, and it's pretty diversified. So I'm gonna get into some of the holdings like I mentioned I would, but I wanted to kind of show you guys the reason I did stuff in the manner that I did. So the first holding is SPHD, which is a high dividend, low volatility ETF. Basically, this stock gives me exposure to a lot of the bigger dividend companies that pay higher yields and have low volatility. Although it has a decent amount of REITs in it to get you the high yield of 5.8%, as you guys can see here. It's kind of a little, the thing I don't like with this ETF is that it's kind of a little, I'd say, overexposed to REITs. So it kind of has, maybe a little bit higher volatility than it says it would, which is not terrible because I'm in it for the long run, and I like the yield that it has. So even if it goes down to 3%, I'm still making almost a 6% yield, which is 3% year over year. And of course, we'll eventually get out of this rut that the market's in right now. So there's that. Then I also added more to my JP Morgan position, which yields 3.8%. And the reason I did this was because I kind of had a super high cost on JP Morgan, which was about $108 or so. And the problem with that was, or it was 110 at the time. It was super high. So I added a lot to my JPM while it dipped to like 95 or 93. And now my average cost is sitting at around $108 or $107, but still not where I'd like it to be. But, it is how it is. And then the next one, like last video, I wasn't going to go through every single one on here as there is a lot, but I was going to go over some of the top holdings with the highest market values, perhaps like the first 20. But yeah, so we have JP Morgan Chase, like I mentioned. Then we have Realty Income, which is a REIT. And I'm a huge fan of this company because they basically paid a stable dividend for over, like, I believe 40 years monthly with no interruptions, and increased dividends for 40 years. So that 4.8% yield, especially now with the entire market gone down again due to the coronavirus striking back again like a villain in a cartoon show, we're basically down to, I think, $59 or $58, which is a good buy because I remember seeing this stock at like $80 or $85 back when the market was super, I'd say kind of inflated, but it was super high. So yeah, it's a good buy with a 4.8% yield, and there's nothing wrong with it because it pays monthly. And then the other one I wanted to talk about was Vanguard. Now, you guys probably know Vanguard, and I read somewhere there was a kind of a statistic that if Vanguard crashed, excuse me, basically a lot of the stock market would take a huge fall with it, and I think the U.S. government would be in trouble too. And Vanguard is like super big, so a lot of people's retirements and stuff like that rely on Vanguard. So out of most of the ETFs that I'm in, I'd say the Vanguard is the safest. This VYM, although it pays quarterly as opposed to SPHD paying monthly, it's a lot safer than SPHD. But, on the downside, it has a lower yield of 3.8%. But you can do with that, as you will, whether you want higher risk, lower risk. I say VOIM is one of the lower risk, high dividend ETFs. And then we're going to look here. So some people kind of brought up earlier, why are you invested in two different companies in the same sector? And this was an interesting question because they were like, if you believe in one company, then you might as well just double down on that one. And the reason is I actually use AT&T and Verizon, so that's why I'm in both of the companies. I do believe in both of them because I use them. Excuse me, but AT&T pays a 7% yield, which is really, really good. And it's much higher than a lot of the stocks on this list, which is why I picked it. But I also use it. It's my day-to-day phone carrier. I have about 3.4K in that stock, and it pays about a 0.5 dividend per share, which is not terrible. Now, if we look at the charts up here again, I just wanted to point something out. The reason that a lot of the stocks are kind of like up and down is because I'm invested in a lot more quarterly dividend stocks than monthly. So this is the averaged off income. And when you guys use TD, they have this neat tool that'll show you. But if you were only invested in monthly stocks, it would basically just all be the same, consistent throughout month over month. But most stocks don't pay monthly dividends, and some stocks don't even pay dividends. So there's that. But anyway, AT&T, Verizon, great companies, high yields, kind of stable history. I believe AT&T is a dividend aristocrat, so it has that running for it, which is really good. And then we have Lindon Basel. Although this stock, I'm not really sure exactly too much of what it does, but I just wanted to get exposed to it because I saw a big dip in it. And it's something that I was planning on holding for a little while and selling out of, so it wasn't really a position that I was planning on holding for a long time. But I mean, if you guys want to look into it, it is a super high yield dividend stock, and you guys might enjoy it. But yeah, so the next stock is Chimera Investment, another one of my riskier plays. I have about 1.6K in this stock. I bought into it because I saw a lot of the financial stocks crash a lot, and CIM was one of the highest market movers on Robinhood. So when I saw that, and I saw its dividend history and that it paid consistent dividends even through this recession, it's paying dividends, or whatever you want to call this. I don't know if you want to call it a recession or whatever, but they're still paying dividends. So I figured, why not add some 12% to the portfolio to just spice it up, But yeah, that's that for Chimera Investment. Take a look at it. Again, don't just buy it off my recommendation, but take a look at the stock, look at the balance sheet, and see if you guys are interested in it. This is the bond fund I was talking about earlier. It's a mutual fund. Pretty stable, low volatility, not a lot of upside, but you get the stable 5.33%. Over here it shows 4.8%. I don't know why, but I believe that some of these yields are a little bit off. Sometimes, most of the time, just a little bit lower. Now for ETFs, the other one that I have is SPHD, which is basically another high dividend, low volatility ETF by SPDR. So if you guys know the same company that runs SPY, they run this ETF as well. So I'm betting my chains on that. I looked at a lot of their holdings and they checked out. Again, there's some REITs in here as well. I know some people have a pick to pull with REITs, so that's your choice to make. But I personally like REITs because although there's not a lot of upside, they have the potential to pay you back a higher dividend because they're a REIT and their cash flow is usually really good, except for this time when there was a lot of economic troubles. But we have a couple of riskier plays below that. We have AGNC Investment Corp, which is another 11.2%, only 1.3K in it. It's a monthly dividend stock, so, it's a recommendation. But I don't have too much faith in this stock as far as the upward trend because I've looked at a lot of the people's recommendations of this, and they say it's not that good of a stock. And it kind of checks out because they have such a high dividend yield, which is they're trying to appeal to investors with a high dividend yield, but the company itself is not that solid. Main Street Capital, I believe in them a lot more than AGNC. Also because if you guys see here from the April to May, we had a run up, which the stock ran up, and it also, has paid dividends consistently, and it's a monthly dividend stock. So, I'm a fan of Maine. And it's another play that I have that I'm going to sell out of probably in a month or two, hopefully with a profit, or 6 months with a profit. It's not something I plan on holding long-term for my portfolio, but it's just a short-term play. This is Sunoco. They're a company that I was invested in, another long-term risky play with 13.57 dividend yield, which is insane and probably not sustainable. And same thing with Energy Transfer, which is another MLP. Kind of a risky play, 17.2% dividend yield. If they pay, it'll be nice. If they don't, it's just something I'm holding for upward kind of growth to sell off. Then we've got Chevron and McDonald's. You know, Chevron, gas company, reliable. People are going to be using gas for at least another 20 years. So there's that. And McDonald's, people are going to keep, eating food and eating fast food and eating unhealthy food. And hopefully McDonald's makes a stride to make their food healthier. But, as it is right now, people are, love McDonald's, and they have for a long time. So it's reliable, and they pay reliable 2.7% dividend. So there's that. Now, there's a lot of other holdings here. And if I went into them, this video would be like over 2 hours long. So what I want to do is I'm going to go ahead and put a spreadsheet in the description detailing all of these holdings. And it's going to, I'm going to make a different one for every video when I do like the monthly dividend updates on the portfolio. But for now, you guys can have a look at this. I'm going to scroll through it a couple of times so you guys can have a look at different stocks. But yeah, I don't want to go into them too much because then I have 100 stocks on here, and that would take forever. But hopefully you guys enjoyed this little portfolio, kind of bringing the VO back and showing you guys the portfolio. This is the yield based on the 138K that's invested. Again, not the most amazing yield, but it's a safer yield, and 95% of the stocks that are invested in, or 90% of the stocks that are invested in, are still paying dividends even after all the dividend cuts. So yeah, if you guys enjoyed the video, make sure to subscribe, like, and comment for any questions you guys may have about certain stocks, or if you guys had any questions in general, and I'd love to help. But that's it for all. Have a good day.